The second and third weeks of December are marked on the economic calendar by meeting of many of the world's major central banks. However, there is no clear synchronization in these policy decisions. Australia, for example, kept its key interest rate unchanged. The US Fed Reserve is almost certain to cut rates by 0.25%, while the European Central Bank may deliver a more significant reduction, possibly as much as a 50 basis points. This forecast is being closely watched by traders, while some already factoring them into their strategies. These different outlooks on interest rate decisions are, of course, a reflection of each country's economic performance. The weaker the economy, the more vulnerable it is to the higher interest rates, which could lead to a depreciation of the national currency. So let's take a look at what economic indicators will be released on December 12th and 30th and how they might affect currency markets. You are watching Traders Calendar. After Australia, Switzerland, and Canada, it will be the European Central Bank's turn to announce its interest rate decision on Thursday. The main forecast is for a 0.25% rate cut. As this reduction has been signaled by the regulator in advance, the market has already priced in this scenario. However, the euro is still likely to face increased volatility. If ECB President Christine Lagarde drops any hints about future rate decisions during the press conference, the euro's movement on the trading chart could become even more pronounced. In general, the prospects for a significant rally in the euro against the US dollar in the near term remain vague. The US economy is still showing solid performance, contributing to rising inflation. Moreover, the US Producer Price Index is expected to show a 2.6% increase in November. If the region is in line with the estimates, the US dollar will have yet another reason to strengthen. The US dollar has a lot of drivers for growth, and the weekly US initial jobless claims report is likely to add to its upside potential. Economists anticipate a slight decrease to 220,000 claims. After the strong November non-farm payrolls report, this will further confirm the resilience of the US labor market. This means that Fed policymakers will have plenty to consider before making the interest rate decision on December 18th. Against the backdrop of a fairly strong US economy, key indicators in other top economies are generally weaker. For Japan, which officially declared an end to 2 years of deflation last year, a decline in economic indicators is particularly unwelcome. For example, the index of sentiment among large manufacturers is expected to fall to 12 points in the fourth quarter. Given that the Bank of Japan would need a strong economy to justify another rate hike, this figure could act as a negative factor and drag the yen down against its major counterparts. Another report that could add to downward pressure on the euro is a German trade balance data. Experts are estimated to have contracted by a further 2% following a 1.7% decline a month ago. This comes before Donald Trump's promised trade tariffs even take effect. For the euro's weakness following this report seems almost certain. On a brighter note for the euro, the industrial production data from the UK could offer some improvement. British industrial production is expected to show a 2% increase, reversing the negative trend. And this could support the British pound and shift the balance in the US dollar index in favor of the euro, albeit modestly. In the Eurozone itself, industrial production is almost expected to show some improvement. The indicator is estimated to have grown by 0.9% in October. However, it will still be lower than in the same period last year, remaining in a negative territory around 1.9%. Nevertheless, this increase could provide some support for the euro, contributing to its gains. Please note that the publication times are set in a GMT plus 3. The next video review of traders' calendar will be released on a Friday, December 13. We wish you profitable trading and see you soon.